Very good afternoon to all of you. And I was listening to the previous speaker. It was very impressive, and I don't think I can match him. But let me try and do my bit. So, Prem is an old friend. We were together at IIM Bangalore, 1991, and this time I have been coming here for number of years. And this time he said, ki, please speak on fund performance. And he knows it very well that our performance is very weak, right, at this point of time. So I was wondering, is he really my friend? Or there is some misunderstanding. But then when I thought deeply about it, actually I have a story to tell you. So let me just share with you some slides. And I think by the end of this, you will realize why Prem has chosen this very year to speak on fund performance. So I think as Mashruwala ji was saying, he was dealing with wealth in a different aspect, but let me just to introduce this issue, take 2 minutes here. See, the key drivers of wealth is asset allocation. And many studies have been done world over, which have clearly demonstrated that more than 90% impact on your wealth over 10, 20-year periods, over generations, is made simply by asset allocation. And at every forum, at every point of time, we have always said that security selection, fund selection, timing actually are overemphasized. They are given a much bigger role than what they ought to. 90% of our time is spent on either trying to time the markets or in trying to do fund selection or security selection. Over long periods, these don't add any material value. So asset allocation is the key, and unfortunately, that is the one which is most ignored. And this very simple slide will convince you about that. This slide gives you, in very simple terms, India's gold imports over last 10 years in dollar billions. And the slide at the table at the bottom gives you the net inflows in equity mutual funds for the entire country over the same period. And you will see what I mean, that India's gold imports have been 10 times that of our net equity inflows over last 10 years. So much for fund selection, so much for performance, so much for timing the markets. But this is where the biggest picture, the biggest impact could have come, and this is what we are missing. So while I'll definitely speak about fund performance, but I did not want to overemphasize that and ignore this, and that is why I shared with you this slide, that how the asset allocation in India is terribly wrong. If we simply start putting in 10, 20, 50% of our gold purchases into equities, even if you buy the median or the worst performing funds, over time you will make far more money than what you will make by investing small amounts in the best performing funds. Just 5-10 seconds on our sense of timing the markets. So all of us invest large amounts of time, effort, energy in trying to time the markets. And this is what is the outcome. So this table gives you the net inflows in equity mutual funds every year for last, I think, since 2000 for last 15 years. And you can see that bulk of the money has come in high PE markets, the orange bars or the red bars. And when PEs were actually very low, the green bars, either no money has come or very little money has come. So our sense of timing is simply this, that when markets are doing very well, the higher are the last 1, 3, 5-year returns, invest larger amounts. And when markets are down, when last 1, 3, 5-year returns are down, when equities are cheap, we don't invest in equities. So this clearly is not a smart way to invest, and we have always advocated low PE investing. So simply don't look at the situation today, don't look at the news flow, just focus on the valuations, because whatever is the adverse news, markets today or tomorrow will discount that. Just focus on low PEs, and if you practice low PE investing over time, you can actually earn more than the average investor. Let me now share with you some thought on the nature of equity markets, what I have experienced. I have been in markets now for almost 24 years. And when I look back, I find this character of the markets, that equity markets have displayed a 6 to 8 year cycle. And if you go back in 1986 to 1992, the old economy stocks did extremely well. and ACC in this period, actually from 89 to 92, went up 30 times. And I think ACC at the peak was trading maybe close to something like 10 times replacement value. So what happens in the markets is very simple. When something begins to do well, more and more people over time join the same theme, and that stock and that sector or that theme ends up in an excess and creating a bubble. Now, whenever a bubble has been created so far, it has corrected only in a market downturn. That is what has been my experience. It may or may not happen in the future. So in 1992, markets fell very sharply. And in that fall, the leadership changed from textile, steel, cement to IT services. And for next 7 years, IT services was the holy grail. And by 99, there was virtually no one who was not invested overweight in IT. In this period, Infosys went up almost 700 times. So again, like the 86 to 92, this time the excess was created in the IT space, the K10 stocks. And these stocks peaked around 300-400 PE multiples. This was an excess, and it again corrected in a market downturn. And the we all know when the dot-com happened, these stocks came down, they lost 90% value. And in that fall, the leadership was once again changed from IT or TMT to old economy. And if you look at the next cycle, 2000 to 2008, in this period, BHEL went up 25 times. There are many stocks in old economy: Tata Motors, Tisco, Crompton Greaves, Siemens, ABB, BPCL, ONGC. All these stocks were multi-baggers. So the leadership changed once again. And I think that phase, 2008, that bull run in the commodities on old economy, that ended with the Lehman crisis. And in that market fall, the leadership once again changed from from capex and related businesses to FMCG, consumer, automobiles, auto ancillaries. And I look at the last 7 years again as one cycle. And I feel that in this market fall, this is my very personal opinion, my understanding, my judgment, whatever you call it. I could be wrong also, but I feel in this market fall, leadership will once again change. And this leadership will change from small and mid caps to large caps, and it will change from consumption and export oriented businesses to local capex oriented businesses. So, this is the perspective I wanted to give you, because now I want to build on this, how to look at fund performance and how do we actually invest. And you will observe in this slide is that every cycle has been a 6 to 8 year cycle. Now, when it comes to fund performance, I think the key job of a manager is to outperform the benchmark indices. And John C. Bogle has put it very nicely. I would recommend that reading book to all of you, Common Sense on Mutual Funds. It's a delight to read. If you just read the first 3 chapters, half an hour, I think you will know more about how to look at funds and measure the performance than what I can explain here. So please read that book. But what I experience, if you go back on this slide and keep that in mind and then look at this, I feel that when you are in the middle of a cycle, a 1, 3, 5 year trailing performance is a reasonably good benchmark to look at. But when a cycle is changing, when you move from cement to IT, when you moved from IT to capex, when you moved from capex to FMCG, when cycles are changing, this measure of fund performance trailing 1, 3, 5 years is not a very effective measure. And the reason for that is very simple. Because when a cycle is changing, you have to sell what was going up for last 6, 7 years, and you have to buy something which is not going up, something which is cheap but which has not done well. Now, perfect timing in this is only possible with hindsight. In my experience, this perfect timing is not possible. So when a cycle is changing, what causes pain in the short run gives you a lot of gain in the long run. And what helps you in the short run causes you pain in the long run. And that is why I feel in market transitions, this trailing performance of 1, 3 year, 5 year periods is not a very effective measure. One way to solve this problem is to look at performance over a cycle. And since cycles are 6 to 8 years times, particularly in market transitions, cycle transitions, I think this 1, 3 year will lead to wrong judgment. There were many funds in 99 which were very heavy, overweight on technology. In 99, their trailing performance was looking very good. Almost 90% of the money in 99 went to technology funds. What was the outcome? It was a grave mistake. In 2007, something similar happened to infra funds. Because the trailing performance was so good, almost the entire 50,000 crores went to those type of stocks. It was a grave mistake again, and you realize it after 1, 3, 5, 7 years. So I think when there is a lot of high P stocks in one space which has done very well for last 5, 7 years, and when there is a lot of value, lot of pain in something else, this measure of simply looking at trailing performance is, to my mind, not the best. And since most of the people like you, investors, media, they focus on this, this puts a lot of pressure on people like me to keep on, to not let go of your winning bets, even if they are very expensive, and not to buy something which is very cheap, more promising for a long period of time, but which can cause immense pain in the short run. So I think this is the framework what to my mind makes a lot of sense, and that is why if you read the book of John C. Bogle, Common Sense on Funds, what he says is simply look at funds which have outperformed the benchmarks consistently across cycles. And I think this is the message what I am trying to give you here as well. This is our performance of our equity fund, flagship equity fund. This is 1 year performance minus the benchmark, and the red line is the average outperformance over the last 15 years. And you will see that there have been 3 occasions when we have trailed the benchmark by a reasonable margin, but we have bounced back extremely strongly. Why did we trail the benchmark? If you look at these periods like 2007, there was a cycle which was changing. If you go back and see 2000, again a cycle was changing. So we have, not by design, but by the way we invest, since we are always thinking, or at least trying to think 3-5 years, in cycle changes, we have typically underperformed sharply. It causes a lot of pain in the short run, but over the next 2-3 years, as the cycle changes, we more than make up for that pain, and that is what shows up in the red line, average 8% outperformance of the benchmark over the last 15-20 years. This is what we have managed to achieve in last, this fund has a history of 21 years. So in 21 years, you can see the NAV is up some 40 odd times, the benchmark is up 7 times. And if you go back and look at the history of this fund, in every cycle, we have moved to the next cycle ahead of the benchmark. So we sold technology in 99, moved into old economy. In 2007, ahead of the markets, we sold capex, bought into consumer pharma. I think in this fall, the way I look at this market, and again I've said this earlier, I think in this fall the leadership will once again change from small and mid caps to large caps, and from consumption export oriented to more capex related businesses. This is what we saw over the last 1 year, 18 months. This is what we have done, and this is how we are positioned going probably. I would like to end with this quote. And the beauty of Warren Buffett and Charlie Munger is that what people like you and me will take 1 hour to explain, they put it very nicely in a line. So what he says is the future is never clear. You pay a very high price in the stock market for a cheery consensus. Uncertainty actually is the friend of a buyer of long-term values. So with that, I would like to end this session. Thank you.
We are shifting from one cycle to the other.
Pardon?
We are shifting from one cycle, we are transitioning from one cycle to the other. But given the fact that the global outlook doesn't look too good, how will that affect this transition? Because you've said that you would prefer capex and you would prefer large cap, but these are the ones which are being affected the most in the current scenario.
Actually, the impact of the global uncertainty is only on the stock markets. It is not on the Indian economy. How does the world impact India? The biggest impact, we have said for more than a decade, between India and the world is the oil price. And look at where the oil price is today. It is $30. So India's current account deficit has fallen from 5% to 1%. And that is great news for us. Our fiscal deficit is coming down, inflation is coming down, interest rates have come down, should move lower. And I think a lot of steps have been taken to revive the capex cycle. Capex by nature is an animal which does not start producing results in a day. To build a simple house, if I give you a piece of land and say, why don't you construct a house on this, it will take you 2 years. So now just extrapolate that to the government. You have to build roads, airports, railway lines, how many clearances, how many problems. But I think I remain very optimistic that capex in this economy will recover, and this capex cycle will actually be better, more disciplined, better regulated than the last capex cycle. So what I am saying in essence is the impact of global slowdown on India's economy is minuscule. It is actually beneficial as long as oil prices remain low. What has, however, been observed is that whenever the world is in pain, whenever there is crisis or panic in the markets outside India, there is a short-term correlation between Indian markets and the markets outside India. But this correlation lasts for very, very small periods of time. And if you go back and look at the last 15, 20 years, whenever Indian markets have corrected, only because globally markets are not doing well, it has been the best time to invest in Indian stock markets. Whether it was 2001, whether it was 2008, whether it was 2013. And I feel no reason why this time should be any different. I think one thing also maybe I could mention here is that what is happening in the world with the oil falling from $100 to $30, about $2 trillion worth of wealth is being transferred from oil producers to oil consumers. There are a lot of countries in Middle East, in CIS, in LATAM, in commodities, Southeast, Australia, which are in serious pain, deep pain. Many of these are on the verge of bankruptcy because some countries 10, 20, 30%, 40% GDP was in oil. Imagine 30% of GDP vanishing because oil prices are down. So there is intense pain in many countries in the world. And most of these countries are emerging markets. And India, for historical reasons, has been clubbed with the same emerging markets. And a lot of FII money which has come to India is from emerging market funds. So when there is pain in EMs and there is a redemption in a EM fund, some selling will come in India also. But I think very soon the investors in the world will differentiate between the pain of these economies and the gain of India. And I think therefore the fundamentals of India are actually improving, and this is why I feel that it is a good time for someone with 2-3 year view, someone with some tolerance for volatility to take advantage of this. Thank you.